I mean, there's a lot of people saying, no, we're just getting started. Well, in my very studied view and being a market student from the time I was a 16-year-old kid till now, and I'm not a know-it-all, but the way I see it, and I got a pretty good handle on markets,
Hmm.
we are in the beginning phase of the last phase. And the last phase is the acceleration phase, which means that people are buying gold and silver because it's the money of last resort, has no kind of counterparty risk, and trust is broken down in the system. So if you don't own gold, good luck. That's the phase that we've now entered. So this is the phase of
So,
the
so
greatest.
are you? I'm sorry. Are you saying that we're the top of the ninth?
I think we're at bottom of the eighth probably, and
Oh,
ready for the ninth for the big picture from 2000 till, let's say, it ends in 2027. That's my take. I'm sticking to it. Doesn't make me right, but I've studied markets for, as I said, most of my life, and you get this in all markets. You see it during the tech wreck in 2000 when the Nasdaq got that all-time high. It took years to get back to that level. You see
hmm.
it in the real estate market, and the metals are no different, with the exception that the metals are the most highly emotional asset class, because when there's a currency crisis and people think that their currency is not going to buy them what they need any longer, they need to substitute it with something that's been trusted for thousands of years, i.e., gold and silver,
Hmm.
that gets into panic buying.
Good day. Today on the show, we're joined by David Morgan from the Morgan Report, and one of the leading voices on precious metals, gold, silver, respected analyst, consultant to hedge funds, high net worth investors, and mining companies. David is known by many as the silver guru, but I know, David, you're also a gold guy. David, is honored to have you here with extremely high gold and silver prices hitting all time highs. It's great to pick your brain.
Well, thank you. It's great to be with you, Steve. Thank you very much for inviting me.
Well, David, price of silver hit 62 today earlier, and I think it's at a little bit under 61 at the moment. How much further do you see this going? Should investors expect a correction? Are we seeing a new floor for silver, and where are we heading going into 2026?
Well, I think we've hit a new floor. That I'm pretty confident about. Whether the new floor is 50 or not remains to be determined. I do think 50 is most likely the floor, but in my private work, the paid service, I told our members that I saw silver and gold both potentially hitting levels, for example, of maybe 3,800 gold and 45 silver. And I really didn't explain that well in the report, which I normally do. It's kind of unlike me. That's less and less possible as we continue to print into the 50s and 60s, but it isn't totally out of the question. But the backup on that is simply this, Steve. If, and almost only if, we see a large sell off in the general equity market,
Hmm.
or even perhaps even the bond market, due to,
Hmm.
again, carry trade unwinding further or some distortion in interest rates because they want to move them down and they go up instead. Regardless, take that kind of event. So if you had like a big sell off in the S&P 500, I could see where that liquidity squeeze could drive gold and silver down into those levels I just described. Barring that, I don't think we're going to see them at those levels. Again, I could be wrong, but I think right now, based on current data, both gold and silver seem to be 4,000 is kind of the low level uh, support for gold and probably 50 for silver. Now, the other questions were what? Refresh my memory. It was where
Uh,
is it going? It's going higher. How much higher? I don't know. When? I don't
yeah.
know. I mean, I published in like 2003. I saw $100 silver as achievable in this secular bull market, which really started in the year 2000 for gold. I mean, there's a lot of people saying, no, we're just getting started. Well, in my very studied view and being a market student from the time I was a 16-year-old kid till now, and I'm not a know it all, but the way I see it, and I got a pretty good handle on markets.
Hmm.
We are in the beginning phase of the last phase. And the last phase is the acceleration phase, which means that people are buying gold and silver because it's the money of last resort, has no kind of counterparty risk, and trust is broken down in the system. So if you don't own gold, good luck. That's the phase that we've now entered. So this is the phase,
So,
the
so
greatest.
are you? I'm sorry. Are you saying that we're at the top of the ninth?
I think we're at yeah, bottom of the eighth probably, and
Oh.
ready for the ninth for the big picture from 2000 till let's say it ends in 2027. That's my take. I'm sticking to it. Doesn't make me right, but I've studied markets for, as I said, most of my life, and you get this in all markets. You see it during the tech wreck in 2000 when the Nasdaq got that all-time high. It took years to get back to that level. You see
Hmm.
it in the real estate market, and the metals are no different with the exception that the metals are the most highly emotional asset class because when there's a currency crisis and people think that their currency is not going to buy them what they need any longer and they need to substitute it with something that's been trusted for thousands of years, i.e., gold and silver,
Hmm.
that gets into panic buying more than, let's say,
Hmm.
the tech sector, which is like fear of missing out. Oh my goodness, I got to get in on this. It's only going to go higher. It's not quite that motivation in the silver and gold spectrum because it's more of a survival, financial survival, trust instinct, more or less, financial instinct, you might say.
So when you say if, like, let's say we're entering the ninth and you don't own gold or silver, you're saying good luck. Like, what are we talking about in terms of how far do you think this thing goes?
Well, let's just say, for an example, that silver goes to 100. Let's make it 120, so it doubles from where it is now. Well, doubling your money in a year's time is pretty hard to do. I mean, most of your top notch money managers that have a stellar track record try to compound at 20% a year. So,
Hmm.
if it doubles in a year, that's like 5 years worth of doing very well. But
Hmm.
that's what we can expect at certain times in the commodities market. So if you don't
Yeah.
have any metals exposure now, I don't think it's too late because if I'm correct, and many of my peer group, Steve, that we
Hmm.
are seeing the de-dollarization at a level that we're probably moving into a different realm, or we have perhaps even a new monetary system based on digital assets in the blockchain. If
Hmm.
that's true, or the push is toward that direction strong enough, the alternative really is, sovereign wealth, which means no counterparty risk, which means gold and silver. So if you're not exposed to it, you're motivated to do so, even at these purportedly high prices. I do believe both markets are overbought, but not overvalued. There's a big difference. What's the real value of gold? Well, I can make an
Hmm.
argument based on the true money supply, the way the Austrians look at the money supply, $20,000 gold in U.S. fiat terms is the true price. And then from there, since silver is considered money by the establishment, what's the correct ratio? 50 to 1, 30 to 1, 16 to 1. No one
Hmm.
knows. The market knows, but you could use those ratios to make a determination on the true monetary price of silver. So let me back off of that and be conservative. $10,000 gold, maybe
Hmm.
a 50 to 1 ratio, which puts what, 50 into 10 is what, $200 silver. I mean, are those, wild, extremes? I don't know. The market does. But I do believe $100 silver is certainly achievable, perhaps 200, maybe more. It's hard to say. But what we do know is that a lot of people are on the sidelines that are not motivated at $60 silver, believe it or not, but they might be at 75 or even 100 because, again, it has to do with preservation of capital. And if they think that
Hmm.
fiat is going to end in tears, going to be worth absolutely nothing, which of course it won't be. But if that's
Hmm.
the motivation, people will come in at 50, 60, 70, 80, 90. They'll come in at almost any price just to have peace of mind that they're okay, that they can physically touch that money of last resort, that money that's been proven for thousands of years gives them faith, peace of mind, and trust.
David, I got caught up with the comment about gold's value being at $20,000. Do you see that value currently? And if you can explain the ratio a little bit more for myself and my listeners.
Sure, I'll be happy. Let me explain that first. It's just a theoretical, paper price of gold. So what you do is you take the base money supply, which is basically all the pieces of paper that are out there, and you have dollars, and then you have ounces of gold that purportedly the Treasury of the United States says, which is
Hmm.
261 million ounces. And you do that division problem, how many dollars per ounce you divide, and you come out with roughly round numbers 20,000. Does that guarantee the price is 20,000 or could be? Doesn't. It's a suggestion of how much paper has been put
Hmm.
against a static quantity of gold. In other words, gold hasn't changed whatsoever at all. So why
Hmm.
is it 2,500, a few months back, and it could go to 20,000? Or why? Let's just be in real terms. Why was gold worth 2,500, whatever it was a year ago, and it's 4,200 now, up to 4,400 recently? Gold didn't
Hmm.
change. That ounce of
Hmm.
gold is the same ounce of gold it's ever been. What's changed is how much paper printing has been has taken place over not only that time frame, but basically over the last 50 years or whatever. And so there's an
Hmm.
accounting that takes place of what is the true value of silver and paper or gold or silver in
Hmm.
paper terms. And let me say it maybe more succinctly, Steve. We are in a phase where I said, bottom of the eighth, moving into the ninth inning as a metaphor, where these two metals take on their ultimate function as money. So if you look back over the 25-year bull market that's been 11 years straight up, a large correction, and now we're in the final innings in my view, it's where there's no limit in a way to
Hmm.
what the paper price could be because up until very recently, both metals acted as commodities. They were trading just above their production cost, which is what you get in soybean oil or cotton or cocoa. Any of the commodities basically
Hmm.
are the cost of production and a margin. The margin is usually pretty modest, except in very rare cases where there's a shortage of lumber and it goes into backwardation, that type of thing. Those are very rare that they even happen, and they usually subside very easily. So in almost all commodities, you can look at what the cost of production
Hmm.
is, put a margin on it, and that's the price. Gold and
Hmm.
silver do that for a very long time, treated as commodities. But when they start acting as the ultimate money, the money of last resort, the money that I have to have because my currency is failing, that's when they take off. And that's what's happened. So this is confirmation that we're in that final
Hmm.
phase. Further than that, if you look at the Dow theory, which I look at in the metals, all the metals have to move together for confirmation. And they have. First, it was gold. Then silver broke out about the same time that platinum did. And then palladium followed. So even though platinum and palladium really aren't money or considered money by anyone, they are precious metals and they do have the same attribute of no counterparty risk. And because of that fact, they travel in that group of precious metals, and they are. So everything I've learned and know to this point in time highly suggests that we're in the last innings and that we are going to see public participation come back into the metals, but probably at higher prices, not based on them getting a good price because I have to look at a price chart and see silver's doubled this year. Say, oh man, I wish I would have bought it at 30. Doggone, 30 sounded high. I never thought it was getting above 30. Finally made it to 35. Regardless of what the backwards thinking may be, that could be reversed overnight by thinking, you know what, if I don't get into gold here, I am not going to have a pension that's going to be worth a darn in the future. That kind of thinking taking.
David, you said earlier that gold and silver are not overvalued, but they may be overbought.
Yep.
For an investor who hears an eighth inning, and you better have gold and silver, but it's overbought. How do you help us reconcile those thoughts together?
Great pushback. Thank you, Steve. Yeah, so all these markets basically trade on algorithms. There's computers that look at the volume and the price and the interaction of momentum. There's a lot of factors that go into these algorithms that basically are trading programs, and they trade against each other. There's not really a lot of human intervention in these markets. And based on that, markets can be overbought, meaning there's just too much momentum and it can exhaust on a momentary basis, on a weekly basis, or maybe a monthly basis. Certainly not a yearly basis at this point in time. So you could get a pullback in both the metals prices, meaning that there's just too much froth in the market. It needs to back
Hmm.
down. It needs to consolidate. It needs to regroup. And what we call is, the congestion has to take place where we get a new base at, I don't know, between 60 and 55 in silver as an example, and between 42 and
Hmm.
4,000 in gold. And it works through that where the bulls and the bears are basically equal.
Hmm.
It's up and down and up and down in a small range, and then it breaks out either the upside or the downside. But in this market, highly suggestive of going higher. And so it's healthy for the market to consolidate. You really don't want a runaway market because if you do get a runaway market, very few people will get in except the
Hmm.
very, very sophisticated, savvy ones that are looking for a short-term trade. But for the long-term investor, it's really unhealthy. So I do expect that the only way to approach it, and I think that's your next question, I'm anticipating. Well, what do you do? What you do is you take a bite. You take a small bite and you continue to take small bites until you are
Hmm.
satisfied you've got some exposure to precious metals, not overdoing it, not panicking, just a
Hmm.
relaxed, calm, logical approach. Say, look, I never bought metals. I really didn't believe in them, but now the currency's depreciated enough. I need them. So what do? I get some, but I'm going to do it over
Hmm.
the next 6 months. I'm going to devote, you know, $10,000 to precious metals. So I'm going 1/3 gold and 2/3 silver because I want the added risk and I'm young and I can afford to take more risk. And I do it over 10 months. I do it $1,000 a month over 10 months. And then I get an average price. That way, if you buy it at 60 and it drops to 55, well, maybe the next month you buy it at 55 and average down. And maybe the next month we get that
Hmm.
stock market sell off and you're buying it at 45. Well, there I would be
Hmm.
inclined to maybe double my position, put in 2,000 rather than 1,000. But if you just have the discipline, put in 1,000, buy it at 45, and it goes back to 50, buy it at 50, it goes up to 55, buy more at 55. Following month is back to 60. So your average cost is lower
Hmm.
than the current price, and then it goes up from there, and you're very happy. But that discipline really pays off, and it takes a lot of the emotion out of it. And that's probably the best thing because really, what are you doing? You're actually turning something that isn't money into money. You're taking a piece of paper that we all are losing trust in and turning it into money that's been valued for centuries. So you're actually just saving in a new form, and it's a form
Hmm.
that preserves your wealth, which is one of the aspects of money, not currency, that
Hmm.
it's a store of value. So you're moving your savings into a store of value, which is really the smart thing to do.
So I wanted to ask you, I do want to ask you about fiat currencies in general, but specifically for the dollar. You mentioned the word de-dollarization. And we've heard that term for a while. Recently, I've heard the current administration talk about dollarization or re-dollarization, and that there. I heard a professor say that there's a more likelihood that we'll see a re-dollarization than de-dollarization moving forward. What are your thoughts on that? And do you see the dollar gaining traction or losing traction?
Well, that's a tough one because I've studied both arguments and they both make sense to me. And that's that's rare because I'm pretty logically oriented, and usually I can make a pretty sound determination. I mean, the argument basically is that so much of the world's debt is based on the U.S. dollar, and you can't pay those dollars back in any other form than U.S. dollars. So if you're in the Italian lira, or you're in the euro, or you're in the Australian dollar, and you owe, a U.S. corporation or a U.S. bank in terms of dollars, you've got to convert that currency into U.S. dollars. So that is the argument kind of for the dollar milkshake theory that you can look up. On the other, we're still printing more than necessary. We're have an oversupply of dollars, if you will, throughout the system. In other words, M0, M1, M2, and M3. You look at all the debt that's out there, or the reverse side of debt, credit. that's been
Hmm.
extended to the world. And that is so astronomically high, it can never be paid back. And so, obviously, in the long term, it's losing value, which it has. The Federal Reserve Board will admit that a US
Hmm.
dollar from 1913 is worth about 1 cent right now. And so, obviously, their mandate to have a sound money isn't sound money, but to have a stable monetary system, they failed miserably and failed totally. But it's happened so slowly that people still trust the dollar, but that trust is accelerating. This breakdown of trust is accelerating. So that means the bond market could have and may in the future have real problems like we're having with the yen carry trade right now, where interest rates are going up and that quote unquote free money that was so easy to obtain, let's say
Hmm.
a few years back, is breaking down. So the whole system's breaking down. You can't print wealth. And that's basically the idea that yes, you can print wealth and you can for a while.
Hmm.
It does work.
Hmm.
In fact, it's worked far longer than I anticipated, but we're now near the end game, which people wake up and say, I really don't want that dollar. I don't want to buy that bond. And the only way I'm going to buy that bond is you give me a yield that I think is worth it to buy
Hmm.
that piece of paper. And that's the predicament that we're in right now. I don't think
So, you know, Keynesian philosophy has been around for a while. We've been in a huge amount of debt for a while. We've been spending more than we've been bringing in. We've been printing for decades. I mean, we've been in the trillions for a good long time. I can't even imagine what a 1 trillion looks like, let alone where the levels that we're at. And so, we've heard, oh yeah, we've reached levels, and you've heard us for years. We've reached levels we can never pay back. I mean, I heard that in elementary school.
sure.
And so, why now? Why are we losing faith in fiat currency more now, seemingly, than ever?
That's a question I can't answer. I mean, I could ask you the same question. There's some tipping point,
Hmm.
and it's occurred as far as we can determine. And that's, again, reinforcing what I said. Both gold and silver acting as money. They're not tied to
Hmm.
their production costs. They're acting as if, you know, the end game is not. What set that off? I can't tell you. It's a psychological event. It's enough participation in the blogosphere. It's in the consciousness of the planet in a way of I don't trust this. And
Hmm.
therefore I got to do something about it. And that's taking hold. Where it started, I don't know. Why it started, I know. Because the ultimate truth is, again, you can't print wealth, and this piece of paper is true value zero. But
Hmm.
no, I know I can buy a Starbucks with it. I know I can pay my grocery bill. But now I'm having
Hmm.
trouble buying my groceries because the amount
Hmm.
of paper that I get per month in my check doesn't buy the same amount it did 6 months ago. In fact, it's
Right.
noticeably. So that's what's the trigger, but it's again a psychological event, and no one can say, "Oh, it's there at that time," and because of this, it's it's indeterminable in my estimation.
So, two questions here. One, you mentioned silver and gold. You couple them together as precious metals, as money. I've heard that, silver is losing its status as money. I love your thoughts on that. And then two, do you see gold and silver being retethered as in returning to money? Or do you see the fiat currency going away altogether? Do you see it being tethered somehow? What are your thoughts?
Yeah, first of all, silver is both an industrial metal and a monetary metal. So I can't say it's only money, but
Hmm.
the best argument is really at law. I mean, I can make the argument that silver is money legally, but not economically. So
Hmm.
there's no doubt with anyone that can think for themselves that I could take a US 1964 silver quarter and walk into wherever I'm at. And when I'm buying something
Hmm.
for $10.25, put down a Federal
Hmm.
Reserve note that says 10 and a 25-cent, 90% silver dollar, the cashier probably wouldn't even notice. They would take it, accept it as money, and there's nothing illegal with what I did. It's still legal tender, printed or minted by the U.S. Treasury. Okay, so it is money legally. I mean, I could win that battle in court any day. However, economically, what did I just do? What I just did was I took something that says 25 cents on it, but it's worth multiples of that in fiat. What is it? quarter worth. I mean, a tenth of an ounce is $6, so probably $20. I just gave him $30 or something if I did the math right. But you get the idea. So economically, no. Legally, yes. And then if you look further than that, the word money and the word silver are synonymous in all the Romance languages. So if I go to Mexico and say plata es no plata, I'm saying silver isn't money or
Hmm.
money isn't silver. They wouldn't know what the hell I'm talking about. They look at me cross-eyed, like, you out of your mind? But but there's many that argue silver isn't money. They can argue all they want. I would win the battle in court. Legally, it's still money.
Do you see currency? I mean, I'm skeptical as to any politicians having any sort of motivation to tie a currency to gold.
Yeah,
Do you
that's
see that
yeah,
returning?
possibly. First of all, I don't think you'll ever see silver officially in the monetary sphere. There's just too little of it unless it's really priced as a monetary asset. And for that to happen, it'd have to be like 1/10 the price of gold. Could it happen? It could. I doubt it. It's officially been demonetized since 1873 or thereabouts. And I could say officially since 1965 onward. But gold's a different
Hmm.
story. Gold is more of an establishment metal. The central banks have been buying it for a long time. They know its value. They know it's their money of last resort. They know it helps their balance sheet. With Basel III onward, we've seen more and more institutional looks at gold. So I could definitely see as the new system develops and is implemented
Hmm.
that gold does play a part in it. Personally, and I'm answering a question you kind of alluded to a while back, Steve, that where do we go, and where we're going in my studied view is into a digital based new system which is based
Hmm.
on blockchain and not tied to gold at all, at least initially. But if that doesn't work properly or is rejected by the populace, then I see it being tied to gold, but it could be wrong. But the short version is, yeah, usually when you go from a fiat to fiat failure, you reestablish gold as the money, and then you drift off the gold standard, move into a partial gold standard, and then you obliterate that. You go into fiat only, and you have a failure, and you go back to gold. So it's fiat gold, fiat gold, fiat gold. Is it going to be fiat gold this time? I don't know. I actually doubt that's what the banking system wants. I think that so many people are unfamiliar with sound money and the merits thereof. You have to be kind of my age or thereabouts to even have an inkling of what a sound money system looks like and the stability that it brings and the value that it brings to preservation of your wealth. Those days are basically at the end of the baby boomers that actually have that knowledge ingrained in them. And so I think it's very easy for the new system to come about where everything's paid by your phone. You never carry cash and you trust a system that, in my view, cannot be trusted to implement a new system that's more convenient, has less friction, is instant pay 24/7. You don't have to wait for that bank wire to hit 3 days later or what have you. And again, the friction, meaning the cost of the transaction, isn't 2.5 to 3.5% for a credit card user that the merchant has to eat. Those could go down to very, very low values. Was like 0.5% or whatever. So there are
Hmm.
some, I guess, advantages, but truly moving into that kind of a realm is one that I see dystopian because it's programmable money, which means
Hmm.
not only can you see every transaction made by the purchaser, you can also implement restrictions on it, saying you can only buy so many, so much stuff that causes such and such carbon credit, or it's over your daily calorie intake, or it's too much meat, or it's too far
Hmm.
travel, or it's a luxury item that you're only allowed to purchase twice a year. All those things rather dystopian and rather bizarre, but actually they do take place because China is basically the beta test for the entire system that the New World Order wants to implement. It's been going on in China for quite some time and it works very well for them.
And by China, do you mean the central bank digital currency, or are you referring to just getting rid of money altogether? That's what you mean, the CBDC?
Yeah, I mean the Bank of China basically implements everything through WeChat or Tencent, and everything's done
Hmm.
basically cashless through their phone. And so you can go into a equivalent of a 7-Eleven. I don't know the proper name in China. There is
Hmm.
no person, there's no human being in the convenience store, but there's all those convenience things, lighters and
Right.
chips and soft drinks and what have you. And you walk in and it unlocks the door on face recognition. So you don't have
Hmm.
to phone up or anything. Sees you, door unlocks, you walk in, you buy a bag of chips and a Coke, you stick it on the counter, it looks at your
Hmm.
face again, and you pay with WeChat or Tencent. And if you don't have your phone available because the battery went out, that's no problem. You can actually put your handprint on a scanner and it will know
Hmm.
you and debit your account and let you out the door.
So we mentioned CBDC. I heard, more than once. I've heard many times that gold, or people can think of Bitcoin as the digital gold. Love your thoughts on that, and love your thoughts on how central bank digital currencies and the rise of crypto could change how investors look at gold and silver. How does that factor in? Is there a meaningful correlation between all this?
There is. In fact, I did a series called The Crypto Conspiracy. It's on my website, which most of the stuff is free information, educational purposes. And on the blog, if you click the blog tab, there is a search engine on the right hand side, upper right hand. Type in crypto conspiracy. There's 30 podcasts on that topic. So, first thing you asked, what was the influence? I think it was basically could be considered.
Hmm.
Remember, I called it crypto conspiracy, so imagine the foil hat on my head. A a movement to move people that would have normally bought into the gold and silver markets into the new realm and basically take monies away from what would have gone into hard money into a cryptocurrency. So it could have been, might have been
Hmm.
psychological. In that series of 30 interviews or 30 podcasts, we go into basically who's who in the zoo. Who started it? Where did it originate from? Was it really Satoshi Nakamoto? Was it MIT? If it was MIT,
Hmm.
who's associated with it? We go through those, and there's some very interesting lines around Bill Gates and some others that you might not have thought in that realm. And then we go further into, does it make sense? Is it truly digital gold or is it not? Now, there's
Hmm.
very, very strong emotions around Bitcoin, and I know that. And I'm free market. So if you're a Bitcoin maxi, then be a Bitcoin maxi. I'm not going to argue with you. I'm not going to push
Hmm.
back on you. You can make your own darn mind up with how you want to invest your money. For me, I think it's past investing in. Everything that it was purported to be in the white paper, the exact opposite is holding now, as a decentralized peer-to-peer payment system. Those are gone. It's not anonymous at all. It can be
Hmm.
traced and tracked. A lot of scams around Bitcoin and the other cryptocurrencies. Not only is it traceable and trackable, but the bankers
Hmm.
have taken it. So it's not a peer-to-peer payment system. It isn't used for that. It's considered to be an endless store of value that can only go up. Well, the last time I was taught that lesson by losing money, one of the great authors in the monetary sphere talked about no tree grows to the sky. In other words, there's a limit to everything. So the last one, which is more logical and more important for anyone
Hmm.
that's actually invested, especially heavily in Bitcoin, and views it as an investment and not as a speculation, should look very hard at how much money the Bitcoin miners are losing because they're losing money hand over fist, year over year, day after
Hmm.
day, week after week, month after month. And if they can't mine it at a profit, they're going to go out of business. Now, I've looked at it deeply. Well, you don't understand Bitcoin, which is the mantra, you just want to push on your emotions. But if you want to look at it logically, there is sort of a governing factor that as the price moves, ebbs and flows, it will slow down the algorithm somewhat. And of course, it'll
Yeah.
try to compensate, but it can't do it fully. So let's use gold as an analogy. If I'm mining gold and it costs me 6,000 an ounce, and the current price is at 4,200 an ounce, I'm not going to stay in business for very long. And that's kind of an analogy for a lot of these major mining houses mining Bitcoin. So
Hmm.
there is a lot of stress in the market. If you don't believe me, just look at their financial statements. Now, their accounting methodologies, which are legal, will make
Hmm.
it look better than it truly is. But the
Hmm.
depreciation allowance on a Bitcoin miner is really about 2.5 or 3 years, which no bank is going to loan you money on something that depreciates that fast. And because of that fact, all those mining rigs have to be thrown out after approximately 3 years, and you got to buy new ones. And the sad part of all that hardware is it can't be reused because it's good for one thing and one thing only, and that's guessing numbers. In other words, the only function it has is guessing numbers and being a Bitcoin miner. So I think there's a lot of energy used in it, and I'm just not
Hmm.
that favorable to it. But again, being free
Hmm.
market, go ahead,
Yeah.
but it isn't gold. It never will be gold. And you can see that clearly if you just look at it logically and objectively. It
Hmm.
doesn't track like gold tracks. It tracks more like a NASDAQ stock. It tracks more
Hmm.
like technology than money. And that's a fact. So I'll
Hmm.
rest my case there, Steve.
Well, that's very insightful. Thank you, David. I want to talk about silver. We've heard the term silver squeeze, a silver shortage for quite some time. Is there really a shortage? Is there a squeeze? I mean, what does the current supply chain look like? Is this coming from silver and gold silver enthusiasts? I mean, is there a silver squeeze?
Yeah, I'd say not really. Let me just make a few points. There's been some backwardization in silver, which isn't normal. It signals tightness in deliverable metal. It usually subsides rather quickly. Rising lease rates tell us the metal's being pulled forward, not stored for the future. But again, that doesn't last forever. And refiners and industrial users don't hedge the same way that traders do. Many care more about the metal certainty than price certainty. So when the market pays you more to deliver metal now than later, it's telling you something that you shouldn't ignore. But it's tightness again, usually temporarily. The central banks are net buyers of gold at a pace not seen in generations. That's causing more tightness. And this isn't about return, it's about sovereignty, neutrality, and settlement risks that we talked about before. And gold is quietly being repositioned as a tier one asset. That covers gold. The silver squeeze really won't happen until there is such a physical shortage that those that absolutely need it, which means the industrial side, and then again, it could be coupled with the investment side, sees into the future that, my goodness, we're not going to get this thing rectified under current supply demand dynamics. I better get it while I can still find it. We're not there yet. I'm not sure we'll get there. We do have a
Hmm.
lot of above ground silver, not necessarily an investment form, but could be turned into investment form, i.e., silverware, jewelry, art objects, religious art objects, those type of things. How much of that exists? No one really knows. There's been a couple studies. I've read them both. One came from the Silver Institute. It was a paid study by the Silver Institute, uh, Edwards and Associates, I believe it was. And in that
Hmm.
paper, or actually a book, it's actually a book, their idea was that most of the recoverable silver from, let's say, art objects and jewelry was about 50% of the market in the 1980s. I know I'm going back decades, but they didn't feel
Hmm.
that there was that much left. Now we've got most of the locked up silver in electronic form, which isn't recoverable in many instances. Some is. There's 150 million ounces
Hmm.
recycled in silver every year. The point I'm getting to is the silver squeeze is a possibility. I don't see it as imminent, and I do see the probability that the
Hmm.
market will clear and will reach equilibrium not too far out, where the bullion bankers have enough physical metal to basically quell the market and calm things down. That's a probability. Are we going to get there? Really depends on the margin. How many institutions want silver as a monetary asset, and how many
Hmm.
industrial users are already worried about their supply and the logistics and the supply chain to say, I'm buying ahead. I need this many ounces. I don't care about the price. I want to stay in business. and have already put in orders for X amount of silver, which
Yeah.
stresses the market. And the next industrial user sees the fact that Samsung has ordered a year supply or 2 year supply. Darn it, what do they know that I don't know? I need
Hmm.
it as well, and actually force a squeeze that might not even come without that fear of missing the ability to stay in business. So that's something I think about that could be taking place currently. I really don't know. The market knows more than any of us, but the supply is obviously tight. And the interest in silver is probably almost as emotional as Bitcoin. Bitcoin is the most emotional investment out there,
Big
but
Bitcoin
silver
feels like gambling to me. Like,
used to have that type of interest emotionally, not as much anymore.
so regarding silver, you talk about Samsung and like kickers that or wild cards that you can't really foresee. Like silver, we understand as base metal, but my understanding is that silver is increasingly becoming more used for the energy purposes as well. Is that true? Do you see that as possibly being a wild card that might really change things?
Well, I just spoke with Mike Lorenzo at the Silver Institute a couple of days ago, and he made the point and emphasized it that AI is certainly going to use more silver. Of course, these data centers need more silver. That's part of the AI equation. And then the uses for silver just continue to increase. I mean, if you look
Hmm.
back 25 years, industrial use was 35% of the market. Now it's almost 70%. And so the demand for industrial use alone almost takes up all the silver supply, according to Matt Watson, on an annual basis. So anything above and beyond industrial use, any monetary holdings whatsoever, means that the above ground supply is being held by tight hands that want it for monetary safety. So
Hmm.
there's a lot to the equation, although it's not real difficult. It's rather simple terms as far as what are the two purposes, industrial and monetary. But
Hmm.
as that gains momentum on both sides at the same time, you can see the potential squeeze that we just discussed.
David, I want to talk about a silver portfolio. I know that you do gold and other precious metals and base metals, but since you're the silver guru and we're talking about silver, uh, you know, do you have any recommendations about how to build a silver portfolio? Like, do you see the best value in majors, mid tiers, juniors? Do you find deep value in equities? Are there jurisdictions you prefer and avoid? And if you can give us any general thoughts that you'd like to share.
Sure. So I'm going to outline mining stocks, the opportunity with discipline, and how to think about a portfolio construction. So mining stocks, opportunity with discipline. Leverage cuts both ways. Mining equities can outperform metals dramatically, but only in phases. And we are in the final phase, as I outlined at the bottom of the eighth. So this is the time where if you want to buy silver for $5 an ounce, you can buy the underlying miners and basically buy it in the ground, maybe at those levels. The idea is sound, not necessarily the price, but you certainly can buy it at a discount if you buy the miners and buy the right one. Jurisdictions, balance sheets, and management matter more than geological late cycle studies because you really want to buy
Hmm.
top tier, unhedged, cash rich miners or our specialty royalty and streaming companies. I avoid the South Africans and have the whole way up this time, even though in the 70s they did quite well and that was a place to
Hmm.
be. I just do not, I think there's too much risk in South Africa. So they don't do much silver mining, but they certainly are 70% of the platinum mining and
Hmm.
still a lot of gold mining. Most investors over own miners and under own physical metals. So there's a balance there. So even though I'm an advocate and most of our report has to do with money, metals, and mining, focusing on the mining sector, not just gold and silver, but other resource sectors like lithium or copper, cobalt, the rare earths, you name it, we've done them all. Gold and silver are obviously at the forefront now. So miners are an optionality on metal, but physical metal is the insurance. How about how we construct a portfolio today? It's outlined in great detail in our second book, The Silver Manifesto. There's a chapter that's quite detailed and rather long, and bit it maybe of a struggle to someone who's not familiar with financial terms, but we'll keep it as you know as efficient for any reader to understand it.
Hmm.
But the ideas in metal are not about beating the S&P. They're about staying solvent across all regimes. Diversification today means owning assets outside the financial system, which in a way, of course, the metals mining stocks are in
Hmm.
stock markets, but they're counter to all the other assets in the stock market. So there's gold is the most negatively correlated to the stock market. Gold stocks are stocks, so they move the
Hmm.
general equity market some of the time, but most of the time they go opposite, like gold, and therefore it's a hedge against, let's say, uncertainty. And the goal isn't a prediction; it's preparation. You need to be prepared for the new financial system that's coming on board. You don't need much metals to get rich. You need them to make sure that you don't get wiped out.
David, appreciate your thoughts on all this. I would love to ask you about the Morgan Report and what that's all about and how people can find you on the Substack socials and your website.
Sure, Steve. Thanks for that opportunity. First of all, the easiest thing is to go to the landing page, themorganreport.com. There's a 1, 2, 3 suggested process. Step one is basically get a free report and sign up for our free email list. Step two is to watch the Four Horsemen film. It talks about the end of the age of empire, even though it's a decade or more old. It's pertinent to today more than ever as far as what's really going on a global basis to the entire monetary system. And lastly, if you're so inclined, you can have a one-on-one with me, not one of my staff, if you're so inclined. So get the free report first. And then I'm on Substack at themorganreport.com. We're on most social platforms. So go again to the landing page of morganreport.com. Scroll down to the bottom, and there are icons for LinkedIn for our LinkedIn presence, YouTube for our YouTube presence, Facebook for that presence, and there isn't an icon for for Instagram or excuse me Substack, but we do have a Substack channel. And lastly, we're easy to find. There is a contact us button if you have questions or want to get involved.
For our listeners, we will put David Morgan's The Morgan Report, his website, the Substacks, and his socials in the show notes. For everyone, thanks for tuning in. I'm Steve Yang, learning alongside you from people smarter than me. Stay smart, stay curious, stay disciplined. David, thanks again for your time, for giving us some good recommendations, and especially during this time, I hope it'll help a lot of people. So thanks so much.
My pleasure. Thank you, Steve.